Hey everybody, this is Jim at SP500chart.com. It's right around noon on Saturday, March 16th, 2013. And I'm doing the video on Saturday because I don't know, just a little bit of a change of pace. I started getting to where I would say, well, I'll wait to see how the futures open on, but Sunday evening futures, I've seen Sunday evening futures be down 30 points. And Monday morning, the market opens up 10. So we're not in that kind of volatility now. That's not going to happen now unless there's some huge earth-shaking piece of news. But I'm not going to worry about that. We're doing this on Saturday. And I told you yesterday I was going to try to read this disclaimer in one breath. I'm going to give it another go. Okay? Here we go. The website and the video are for educational purposes only. Nothing stated at the side or in the video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. I'm not a licensed financial professional. I am just a guy who draws lines on charts. I did it. So now, let's take a look at those charts. And if you didn't understand a word of it, read it. There. Okay, we're starting out here looking at an hourly chart of the S&P. Had its first down day in what? 10 days? Was it 10 days of up and then finally we have a down day? And I'm looking at it in this context because it's very interesting how here's our lower support line that has broken before, but then we got back into that channel that lasted for the entire range of trading from January 2nd, being the first day the markets were open, until it broke in late middle February. And since then, we made this inverted head and shoulders pattern. And interestingly, now the S&P has been just winding away its way around this lower line, almost like a DNA helix. It almost looks like it's just like a vine, just kind of curling around this line. That's just kind of what it looks like to me. It won't get significantly over it, and it's not getting significantly under it. It's just teasing this line, and has been for almost 2 weeks now. So, let us look at it a little bit closer. You will see that even though yesterday was a down day, that this smaller light blue channel, here's the support line, here's the resistance line, we bounced twice on that line. Look at it on our 10-minute chart. There. I didn't move this line. This line is right where it has always been drawn. And look at that. Bounce on it early, bounce on it late. Does that mean we're going to keep bouncing on this line for the next 10 days? Yeah, I doubt that seriously. I remind you, this green line is the, quote, official, very carefully drawn target line from our inverted head and shoulders pattern back here. How do we get that line? And watch me draw it, and it comes out to be something different this time. It shouldn't. We measure the depth of the head from the neckline. Remember what the neckline is. The neckline is a line drawn from the peak that starts the formation of the head and the peak that starts the formation of the right shoulder. Now, of course, I'm speaking in terms of an inverted head and shoulders pattern. If it's a head and shoulders top, then instead of the peak, it would be the dip. But still, it is what defines the head part of the pattern. So we take this and we add it to where it broke out, in this case, which was on the 5th of March, and we run that line up, and that gives us our target. This is a horizontal line right here. So we are really. I made the comment over in the forum that this is close enough for government work. But I've made that call many times in the past, and let's be honest with you, I'm human. When I point out a pattern like this, and this is a paid subscription service, guys, I want to be right as often as I can. Even when it was free a couple years ago, I wanted to be right as often as I could. And so I would see a pattern like this, and I would draw the target, and then I would say, well, that's close enough for government work. And almost invariably, at some point in the next couple of days, we got a solid tag on the line. Well, I'm going to do the same thing here. This is close enough for government work. That 1563-ish, wherever we got 1562 and high change, wherever it was, I don't remember exactly. That is good enough. That is within 2 points of this target. But probably this next week we're going to tag the green line in a solid way. Just wouldn't surprise me. So guys, that is kind of where we are right now. I will remind you that if the market turns south on us, we have this brown line on the chart, and you might say, well, Jim, that brown line should give a bounce. I would say, no, it really shouldn't. The reason is that's an ascending line. I know it's not going up at a very steep pace, but that is our tops line, if you will, drawn over some of the more important market tops. Here, starting with the high of 2010. And where it really is drawn mostly is the high of 2010, and then the two highs in 2012 line up perfectly. This pattern gets over it a little bit, but you can see that when we had those highs set in the spring of 2011, this line did not provide support once it got taken out. It maybe gave a little homage, however you say it, to this line. Maybe we got a little short-term bounce, but really you can see that it pretty much just did not have any trouble getting down under this line. Got over it again, under it, over it, under it, up to it. Then we saw some serious selling take place. We are now over that line again. So for what it's worth, I think you have to take the same mindset into this line as we do with any rising resistance line that gets taken out. That if it's a rising line that gets taken out, you cannot count on it to provide support of much value at all on a retest. If it were a descending resistance line and you break it out, then you would expect a back test to produce a bounce. But when it is an ascending line, you just see you just don't see it. It's nearly as often. So, okay, time for a weekly review. The weekly review says we ended the last week having identified this support line in a potential channel, and made mention that if we break this line, that's likely going to be setting up a short-term top. I think we are very likely in that process right now. You see that once this line broke, we went sideways. It broke on Tuesday, but it never broke by a huge margin. So for that reason, I'm a little reticent to say this is a serious issue up here. I don't think it is quite yet. As a matter of fact, I don't think if we get a sell-off, I don't think it's going to be a real deep sell-off. Not quite yet. I think eventually it will be, but not quite yet. So to make a long story short, here's this line. We broke it, came back for an almost perfect back test of that line on the open of the 14th, I believe it was. Then we just kind of went sideways for a bit, and you'll remember I pointed out that, well, it looks like we're kind of in this little short channel here. But on Friday, that came back down, back tested, bounced on our blue line, tried to get back, then broke this little gray line again. Now we bounced on this blue line again. So all of this to say, and by the way, these are tiny little patterns that are only 5, 6. In some cases, this little thing here is what, 3 points tall. These are minuscule little patterns, but I still want to keep track of them, because I was watching a show the other day, and they were talking about the things in the world that we don't see. And one of the things we don't see in the world is we don't see the almost microscopic damage that takes place to an airplane frame. That through the process of heating up and cooling down, thousands and thousands of cycles, as these commercial jets go from being 100 degrees on the ground to 100 below, up in the, at 35,000 feet. This is going to relate, bear with me, that they start to develop very, very, very small cracks. So what we're looking at when we're looking at things like this is we're just examining the cracks. Because I think when this does turn south and we start to see a larger fissure in the markets, that we will see the signs of that in the cracks. But right now, we don't see it. We see still being in an ascending channel that is hugging this lower, what used to be support, now looking like it's more, it's not support, it's not resistance, it's just a magnet. That's very interesting. So we're just kind of in and around this red line, as if the market cannot really, it's obviously going up, but the market really can't make up its mind if it wants to go really up. Because I'll remind you, when we were in this red channel back here, we would have days where the market would move 40 points, in 3 or 4 days. And here we have moved 20 points in 10. So it's in other words, usually in this kind of channel, we would go from the bottom to the top, from the bottom to the top, from the bottom to the top. But here we're just kind of melting up in and around this red line that has a history. Kind of like there's this very small little tug of war that's taking place right on this line. Since it is ascending, I think it's safe to assume eventually the tugging to the downside should take over. Because the bulls are not strong enough to pull this on up to this top line. Instead, they're just kind of, no, we're not giving up. No, we're not going to break that line. We're not going to break that line. And the bears keep saying, we're keeping them close to this line. We're not going to let them run this market on up to the 1580s now. We're going to, so there's a real fight being waged on this line. And again, the chart isn't just a chart of price movements. It's a chart of the psychology of what's going on. And right now, it is a hard-fought battle in the trenches. If you want a football analogy, this is an offensive line and a defensive line that are just, they're in the trenches. And the offense is moving the ball 1.5 yards at a time. No big plays yet. And that tells me that offense is likely not going to be strong enough to keep it up much longer before something breaks and we start to come down and test some support levels. So guys, there you have it. There's your video, weekly review, and we didn't really take that much of a look at what happened yesterday, but well, we did. We talked about the little back tests here and there, and But for what it's worth, 2 days of sideways, slightly down across the board. And I just want to remind you of one thing. Be careful. Keep an eye on this. The headlines are starting to show some of the psychology that is typically associated with tops. I'm going to show you one more thing. There have been a couple times when I was thinking that we were very likely, based upon the chart pattern, where I was thinking this could be a significant top. And one of those times was actually back here in 2011. And the only thing that bothered me about this Head and Shoulders top was the fact that there was just too much bad news. There was too much fear. And right now, folks, there is very little fear in the market. And when there's very little fear, as stupid as this might sound, when nobody's afraid, you should be afraid. Because when nobody's afraid, the markets absorb as much money as they can. Because nobody's afraid. Nobody's sitting on a bunch of cash going, I don't know, man, this stock market thing scares me. No, it's not scaring anybody. Let's take a look at the VIX real quick. Looking at the market volatility index, the VIX is the lowest it's been since the wheels came off the market. And you can see it's a very interesting chart to look at. I don't really chart it, but I refer to it every now and then. I will remind you, though, that we are not down at historic lows. And the historic lows actually preceded the crash in 07, preceded it by a good bit. So you can see that the lack of fear, if you will, in late 06 really didn't play out until we got into the latter part of 07. So for what it's worth, I just use this to indicate that it appears that there's not much fear in the markets right now. And I'm not saying that you should trade the VIX or any of the derivatives of it, because frankly, if you did, you would play it on the short side in those short ETFs or whatever. They'll kill you because they have a tremendous amount of contango that creates decay in the futures contracts. But to make a long story short, I just show this to show you that there's no fear in the markets right here, and there's less fear than there's been in a good number of years. So take that for what it's worth. So going forward into the week, I would say, and that's the week that begins on March 18th, I would say watch to see if we stay in this little light blue channel. See if we get enough steam behind the market to make up that last 5 points or so to reach this green line. And after that, let's see if we set up a reversal. And if we do, even though this inverted Head and Shoulders has made its minimum target, it'll be interesting to see if we do reverse back, if we find support. Like I said, I don't think we're going to find that much support on this brown line, but could find some support here at about 1526. And then we've got a rising line right here that we can talk about. If we get down to that, we'll revisit some of these other potential support levels. Finally, I just want to ask you, if you are not a subscriber to SP500chart.com, why not? Could you spare me a cup of coffee every day? A cheap cup of coffee at that. your subscription to SP500chart.com entitles you to a fresh video analysis of the S&P 500 after each day's close. You get the video after that day's trading. It keeps you current with these chart analysis techniques. Does it always work? Of course not. But we've got a lot of happy subscribers. And I just would encourage you, hop on over to SP500chart.com, check it out. Thanks for watching the video. Everybody, take care.